South Africa didn't miss the Hormuz crisis. It priced in the fear. It has not yet priced in the shortage.
Welcome to the SA Residential Wrap by CanDoo World. CanDoo World bridges the world between real estate and AI and offers real estate transaction and funding advisory and AI training and skills development tailored for the real estate industry. Please like and subscribe to be notified of new releases and support our young channel. Today, the Day 45 Cliff. I'm Sarah, joined as always by David, and today we are looking at one story with the depth it demands. The Hormuz Strait has been closed for weeks. South Africans have felt the first wave, the fuel price, the rand under pressure, the headlines. Most people have concluded that the worst is already here. That conclusion is wrong, and in this episode we are going to explain exactly why and what it means for anyone who owns property, builds property, or hopes to buy property in this country.
Let's start with a piece of framework that I think is genuinely clarifying. There's a distinction that most people are not making, and it matters enormously. There is a price shock, and there is a physical shock. The price shock is what happens when markets react to the threat of disruption. Brent crude sitting between $95 and $110 a barrel right now. That is the fear price. It reflects what traders think will happen. The physical shock is what happens when stockpiles run out and materials simply stop arriving at the places that need them. Factories stop, building sites stop, logistics chains break. That is a different event, and it comes later.
So give us the timeline. Where are we right now?
There's a model developed by Professor Robert Pape at the University of Chicago. He spent 30 years studying economic blockades, and his framework for how Hormuz disruptions transmit through the global economy has a specific clock. Days 1 through 45, fear-driven price surges while global stockpiles buffer the physical gap. Systems feel it, but they hold. Day 45 is the cliff. Stockpiles are exhausted. True shortages begin. Factories stop, not because the price is too high, but because the material isn't there. Days 60 through 90, that's roughly June through mid-June, 20% of global oil supply and 30% of global fertilizer access is lost. Not a forecast, a scenario that is now in progress.
And Day 45 falls when?
On or around the 1st of May, which means, as this episode airs, we are sitting approximately 2 weeks from that threshold.
2 weeks.
And the reason this matters specifically for South Africa is our import profile. Oman supplies 34% of South Africa's diesel. The UAE supplies 20% of our diesel and 35% of our petrol. Both of those routes pass through the Strait. Alternative sources exist, but not at scale, and not at the prices the current market was built around. April's fuel prices are not the floor. The Road Freight Association has been explicit about that.
So let's talk about May, because I think there's some confusion in the market right now about where the projections sit.
There is. Early projections had petrol approaching 30 rand a litre and diesel approaching 40. Those numbers have softened in recent days, and the mid-April Central Energy Fund snapshot puts petrol 95 closer to 26 rand and diesel closer to 34. But the direction is still sharply up from where April landed, and the final figure won't be confirmed until the 6th of May. What we can say with confidence is that May is materially worse than April. And if the physical shortage that the PAPE model projects for Day 45 begins to bite before that adjustment date, the numbers we are discussing now may themselves be revised upward before the pump price is even set.
So the projection is a moving target, but the trajectory is not.
The trajectory is up. And diesel is not just what you put in your bakkie. Diesel is what moves every truck. Diesel is what powers every generator that keeps a construction site running. Diesel is the price embedded in every delivery, every logistics route, every material that arrives at every building site in South Africa. When diesel spikes at that scale, the entire cost structure of construction reprices. In weeks, not quarters.
The projected increase in petrol and diesel prices is particularly notable. Inland diesel prices are expected to reach approximately 36 rand per litre in May, while petrol is projected to be around 30 rand per litre. We are focused on the oil price, but there is more to the story than what South Africans pay for fuel than the US dollar price of oil.
Correct. The rand-dollar exchange rate accounts for roughly half of the petrol price. The rest is driven by, let's call them extras, and brings that to some 60% of the petrol price over the last few years. Those extras are basically the retail margin, what the fuel retailer is allowed to charge. That figure is determined by government, and the rest is tax, storage, and transport.
If you look at the pure rand price per barrel of Brent crude oil, you can see the recent spike. But what is interesting is that we have seen worse in the past in 2022. But the prices are so much higher now as we saw on the previous slide. Is that because of the extras you mentioned?
Yes, around 16 to 17 rand of every litre of petrol is the dealer margin and government taxes, storage and transportation. And that has consistently been increasing over the years. And we saw government provide a temporary 3 rand per litre reduction in the general fuel levy in April. Without that, we would be paying even more.
That 3 rand per litre is what's standing between the current price and 40 rand per litre of diesel next month. Consumers and the economy need government to hold that. But we just don't know how long they will be able to do so without having a material impact on tax revenue collection.
Yup, government would have collected 6 rand 87 per litre in April. This month it's 3 rand 87.
Which brings us to what I think is the more revealing half of this story. Because people understand the fuel price in their lives. What they do not understand, and what our research shows, is what is happening to the physical inputs required to build buildings. The cost of a window, the cost of the road surface, the cost of getting the material to site. And then, beyond the building site, the cost of feeding the household that any new development needs to attract and retain tenants and maintain healthy rental collections.
Let's take bitumen first. South Africa now imports 100% of its bitumen requirement. No local production anymore. South Africa has shifted from being a net exporter of bitumen to a total importer. This happened as the major refineries which produced bitumen as a byproduct of crude refining shut down. The primary suppliers are Bahrain and the UAE, both routed through the Hormuz Strait, both now disrupted. Singapore-sourced alternatives exist, but they arrive at prices around 16,000 rand per tonne. That's a 60% price increase compared to around 9,500 to 10,000 rand per tonne earlier this year. Approximately 80% to 90% of South Africa's bitumen import volume is destined for road construction and maintenance. The remaining 10% to 20% is critical for several high-value industrial and building applications. At that price, large-scale road construction becomes cost-prohibitive. Township development roads, estate surfacing, public infrastructure upgrades, all of that is now in jeopardy or increases construction cost.
And aluminium?
Bahrain supplies 42% of South Africa's unwrought aluminium imports. Aluminium is above $3,500 per tonne, approaching $3,600, a 4-year high. The direct effect is an 8 to 12% increase in window, facade, curtain wall, and cladding pricing. Now, facades and fenestration typically represent 8 to 15% of total project cost. An 8 to 12% increase in that line item, on top of every other input that is repricing. That is often the margin that separates a financially viable project from a shelved one.
And then there is the looming food price increase, which I think is the piece that many in the property industry have not yet connected to what is happening on their building sites and property investments.
The Strait of Hormuz carries 35 to 46% of global urea trade. Urea is the primary feedstock for nitrogen fertilizer. It is what grows the food. The price is already up 77% from the December 2025 baseline. That increase has not yet fully transmitted to retail food prices, but it will. The pipeline from urea price to food basket cost runs through the planting cycle, through transport, through processing. And when diesel is simultaneously repricing every step of that chain, the food price increase that arrives on the shelf is a compounding of multiple shocks, not a single one.
And similarly to bitumen, 100% of South Africa's urea is imported. While the country has a significant domestic fertilizer industry, it lacks the specialized synthesis plants required to manufacture urea from ammonia and carbon dioxide at scale. Households are facing a multi-frontal assault on their finances, at the fuel pump and at grocery store to name just two.
Exactly, and this is where the construction story and the household story converge. Planned development projects either being cancelled or put on ice because construction costs could blow through the feasibility because the Middle Eastern conflict has repriced the whole build, and it's the social and affordable end of the residential development market that will be hit first. It's where the margins are slimmer and projects just less financially attractive. That is the supply that was supposed to give the lower-income household somewhere to live at a rent they could afford. New supply is being squeezed at precisely the moment household disposable income is being crushed. After transport, after food. Less supply and lower affordability after taking other household cost increases into account.
households are likely to start pulling back on food spend, opting for cheaper alternatives. The crisis in Middle East is also a potential nutritional risk as well. Let's pivot back to construction and discuss the construction contingencies, because I think that's a number people haven't thought of.
Industry sources are reporting surcharges of 10 to 15% as standard clauses in new building quotes. These are not material cost increases, they are contingency buffers. The contractor protecting themselves against price volatility between the date they quote and the date they procure. For a developer who signed a fixed-price contract in early 2026 and is procuring materials in May, they are absorbing that gap out of their own margin. For a developer considering a new project in May, they are being quoted 10 to 15% above what the market was pricing 3 months ago.
So the developer who was viable in January may not be viable today, not because of interest rates, not because demand has collapsed, but because the physical cost of building has moved beyond what the feasibility can absorb.
And the Reserve Bank cannot fix it. The SARB held the repo rate at 6.75 in March. Prime sits at 10.25. And the SARB cannot cut into a supply-side inflation shock. Cutting prime does not put Bahrain aluminium back in the market. It does not reduce the Singapore bitumen price. It does not bring urea back to December levels. Every month the Straits stays closed is another month without rate relief, and another month where property development is absorbing both current interest rates and input cost surges simultaneously. A developer who structured their feasibility around a June rate cut is now modeling no relief before September at the earliest. That is a 6 to 9 month shift in the rate timeline, enough to make some developments unworkable without selling price or rental increases in a market where consumers are now forced to cut spending.
Let's use Waterfall City as a quick lens on what the labor dimension looks like.
23,000 jobs in that precinct, workers commuting from Tembisa, from Soweto, from Mayatan, because they cannot afford to live where they work. As petrol and diesel spike and climb, taxi economics break. Fares spike or routes disappear. Workers who cannot get to work don't come to work. And we're going to cover the scale of the impact on consumers for the property sector in a coming episode.
And when you pull back from the individual precinct and look at the residential sector as a whole, what's the honest assessment?
Residential is the sector carrying the largest social consequence in this crisis. That is not a contested point. We can expect a 3-month transaction near freeze in the residential market under the Day 45 scenario. Not a slowdown, a near freeze, as households recalculate their operating costs against the new fuel and food price reality. Discretionary property decisions get deferred. That flows directly to transfer duties, bond origination, conveyancing, agency revenues, business across the chain contracts, and unlike a rate-driven slowdown, there is no single lever that reverses it. You cannot interest rate cut your way out of a supply shock.
So before we close, David, the thing that keeps coming back to me in all this research is a distinction that feels important between what has happened and what is about to happen.
The fuel price is the visible metric. It shows up on the petrol station billboard. It shows up in the WhatsApp forward. People have processed it. They have made a kind of peace with it. But the fuel price is the fear price. It reflects what the market thinks will happen. The physical shortage, the one that empties shelves, stops factories, halts building sites, makes road construction economically impossible. That comes when the stockpiles run out. South Africa absorbed the announcement. It has not yet absorbed the arrival of physical shortages. And that gap between the price event and the physical event is where property decisions made in the next 30 to 60 days are going to look vastly different in hindsight depending on which side of Day 45 they end up on. For developers, the question is not, will rates come down? It is, can I get materials at a price that makes this project work before my funding covenants breach and my development becomes financially unviable?
And on that note, we will close because it is an open question and it